From theCUBE studios in Palo Alto and Boston, bringing you data-driven insights from theCUBE and ETR. This is Breaking Analysis with Dave Vellante.
Few brands in technology carry the storied pedigree of Intel. I mean, for decades, Intel Inside, it was synonymous with progress in computing. It was an American icon. Intel repeatedly raised the bar on processor performance and innovation. And today, Intel finds itself, of course, in the news and in a precarious position. Its once vaunted manufacturing machine has fallen well behind TSMC, which dominates the process node business. Meanwhile, Intel's core CPU design business, which is substantial, even though it's bruised, it's a revenue engine for the company, and it remains overshadowed by the mounting losses in its Foundry business and the capital burn associated with Foundry. So rumors, of course, are swirling about Broadcom, and so we've heard about Qualcomm that might step in and scoop up Intel's design business. But for those who believe in competition, national security, and the long-term integrity of an American technology brand, that outcome, in our view, would be deeply misguided. Hello, and welcome to this special Breaking Analysis, where my colleague, David Floyer, and I last week published a breaking analysis around Intel and how it should remain independent. And today, because we didn't have an opportunity to do the video, we're going to add that in today, and we'll add that to the written piece, which of course you can find on thecube.net and siliconangle.com. We're going to walk through how a spin-out might unfold, including an updated scenario of our original bold plan to spin out Intel's Foundry. If you haven't read that, you'll also find that on thecuberesearch.com. In this scenario, TSMC anchors a U.S. domiciled joint venture, and we're going to detail why the Foundry must command a massive discount despite all the capital that Intel has put in. We're calling for perhaps as deep as a 90 to 100% discount of Intel's sunk investments, and how a take or pay wafer pre-purchase model from hyperscalers, and we're here talking about Amazon, Google, Microsoft, Apple, Meta, and NVIDIA, how those companies, through committed volumes, can sustain a new American-based foundry while freeing Intel to focus on design excellence. Let's take a look, if you guys don't mind bringing up the first slide, let's take a look at Intel's current predicament. And we're going to start with wafer volumes. This is something that David Floyer and I published last September. And you can see here our estimates of the wafer volumes from the period 2014 to 2024. Obviously, 2025 is going to increase this gap, the red line, TSMC wafer volumes. And you can see Intel wafer volumes. This all goes back to 2012 when the market for PCs peaked, the unit volume of PCs peaked in 2012, 2013. At the time, David Floyer wrote a piece about, hey, this could spell trouble for Intel. They chose, it's all well documented, they chose not to participate in the iPhone. A lot of people say they missed mobile. They didn't miss mobile. They were actually dead on in mobile and wireless. What they did miss is smartphones, and that allowed ARM to step in. ARM wafer volumes today are at least 10x the wafer volumes of x86, which of course is Intel's staple, their core product, their flagship product. Guys, if you could bring up the next chart, Intel's current predicament, we're going to stay on that. And the issue here is its costs are simply non-competitive. And so if you look at this chart, basically what we're showing here is the additional Intel cost per wafer relative to TSMC. Now, we'd use this did these calculations using Wright's law. Wright's law, a lot of people don't know about Wright's law. They've heard about Moore's law, but they don't know Wright's law. Wright's law basically says, as in any manufacturing, as your cumulative volume output doubles, your cost decline by a constant percentage. In semiconductors, let's call that 15%. When you add in the incremental improvements of Moore's law, when you switch to a new node, you get 30% performance improvement. Let's call it 25 or price performance improvement or cost improvement. When you switch to a new node, let's call it 25, 30%. This is vital because when you make your first wafer, it's not profitable. It's more expensive. But at volume, at steady state, Wright's law says that your cost decline by a constant percentage. Again, semiconductors, let's call it 15%, throw in increased density, and you're talking about 20 to 30% cost improvement. Now, in 2014, Intel, they could get away with a 10%, or even 2017, 2018, 15%, price per wafer disadvantage. But as you now come out to the middle of this decade, you're talking about a 35% advantage for TSM. So, the bottom line is that you can't compete unless you give away the volumes. Thank you, guys. And so the point that we want to make here is that Intel's predicament, they are in essentially what some people would call a death spiral. We would call it that. Now, so that's sort of the setup as to why Intel is in such a difficult position. And we've documented this extensively. If you bring up the next chart, it's a bullet chart. I apologize for that. But we're talking here about why selling the design arm to Broadcom or any other suitor we think is a mistake. So there's rumors, acquisitions about Broadcom. We've heard about Qualcomm acquiring Intel's design business. Our point here is this is a fire sale, and it's really short-term thinking. It's shame on the board that allowed Intel to proceed with a flawed strategy around its integrated device manufacturing business. We had said many times, unless Intel had unlimited capital and unlimited time, which it didn't have, it would never work. It would go bankrupt trying to do that. And that is the path that they're on. So back to the boards, if the board decides to sell Intel's design business, on the cheap, the stock right now is depressed because of Foundry, because of that flawed strategy. And so, selling now would be at a low point. You don't want to sell low, you want to sell high, of course. Now, Intel's design business, we see that as a leading design company, and we don't want to see more concentration, even though we're a big proponent of M&A, and we've been so critical of Lina Khan. That to us is not the ideal scenario. We don't want to see that happen, and we think this is a time when regulatory scrutiny would make sense. We think they should face, serious scrutiny. Thank you, guys. And so the last point we want to make there is that, look, Intel's design operations, they are viable. They could thrive. And so we really would like to see that given a chance. All right, if you would, bring up the next slide. Again, it's another bullet slide, but we just kind of want to emphasize this point. We've said before, Intel's got to exit the manufacturing business. Its foundry operations have negative economic value. This reminds us of IBM essentially paying Global Foundries to take its microelectronics business. And essentially between that and AMD spinning out its foundry business, remember, Jerry Sanders used to say, real men own fabs. Well, it turns out, Lisa Su, real women know how to run companies in this century. And AMD has thrived, particularly because it was able to shed the weight of its foundry business. Now, unfortunately, it didn't work out great for IBM and Global Foundries. IBM paid an estimated, about billions. I think the number was $3 billion, or maybe it was $1.5 billion, and they committed another $3 billion in R&D, so they could get 7 nanometer and more advanced manufacturing nodes. That didn't happen. We would argue it didn't happen because of Wright's law. Global Foundries just couldn't compete because it didn't have the volume. And as such, it tapped out of that deal. IBM ended up suing them, and it was pretty ugly. But again, it shows you what Wright's law will do to you. It is unforgiving. Once you get into that death spiral where your cumulative manufacturing volumes can't double, you can never catch up to the volume leader. The other point is 18A. Everybody talks about 18A, how great 18A is. 18A is going to be unprofitable. 18A is not the savior of Intel Foundry. 14A, to the extent that 14A would actually ship on time and could deliver good yields, potentially would be a leapfrog move. But the problem with 14A is it's really unproven. You're combining backside power, gate all around technology, and NAEUV, which is again unproven. Those three things together, problems tend to multiply when you push technology like this in semiconductor manufacturing. So we don't think that Intel was in a good position to do that. With TSMC, they might be able to, and we say they were more likely able to bridge to 14A, and they might be able to be able to make 14A something that is what we think a more viable solution than what it would have been able to do in Intel's hand. We'll never know, but that's our assumption. So what we're calling for here is a US-based joint venture with TSMC, and this is critical. TSMC has to provide the expertise, the IP, and the engineering talent physically. They got to fly engineers over and re-domicile them in the United States, period. Otherwise, this deal doesn't work. Now, why would TSMC do that? They do that because they are going to get a major stake in this new venture, and it's a hedge on China taking over Taiwan. We're also calling for the CHIPS Act funding to be redirected, and we'll lay out the numbers there. In our original scenario, we had private equity taking a piece of this, and in our discussions with PE companies, and like, yeah, well, we really don't love the foundry business. The returns aren't great. It's very long term before you get a return, but we'd be happy to lend them some money, and because of the risk, maybe take a little equity with that debt. But the bottom line is Intel is going to have to accept a big discount. And thank you guys. And TSMC would be the primary operator, with Intel really retaining only a small portion here. And while it's a tough pill to swallow, we think it's the right one to preserve U.S. manufacturing, or actually bring back U.S. advanced manufacturing, and to preserve an American icon. Let's go on to the next slide. This is, I think, pretty controversial, but it's something that we want to call out. We've heard that the discussions with the Trump administration, or TSMC, will take 20% of the joint venture. We're calling this the Foundry of America, and this is our hypothetical cap table. So we think TSMC, the value of what they bring, we're calling it $30 billion of critical IP and operational expertise. Maybe the thing we missed here, maybe they should throw in some cash. We're not saying they throw in $30 billion. We're saying the value of their IP that they bring here and their operational expertise is $30 billion. So they get 45% of the company. Maybe that's a little rich. Maybe that should be down 30 to 40%, something like that. But it's got to be a substantial portion. Intel, we could make an argument that Intel should get nothing, but look, because Intel's providing the equipment, even though that equipment is of negative value, or those foundries are of negative value, and people might ask why. Well, why is that? The reason is it's going to take, in our view, 3 cycles of foundries for Intel to just reach break even. So the first set of foundries will lose money. Second set of foundries probably still won't be break even. Third set of foundries maybe turns a little profit, maybe break even. And you're talking about 3+ years, maybe 3 to 4 years for each group of foundries to get to wafer volume at decent yields. So you're looking at 3, 6, 9 to 12 years before it starts to turn a profit. So 7% to Intel is a gift in our view. Now, the U.S. taxpayers and the CHIPS Act, we'd like to see that redirected. We're saying $27 billion in public funding and loan guarantees. Maybe it could be a little bit more than that. Maybe you want to see the U.S. taxpayers and the U.S. government having an equal share with TSMC. That's a possibility. That's all up for negotiations. But the U.S. taxpayers should get a significant chunk of this, because we're making it happen. We're putting in significant funding. And then finally, private equity. Put in $5 billion in equity, and then put another $20 billion in debt financing, or maybe it's all $25 billion in debt financing, but give them a piece of the action as well. Thank you, guys. Appreciate that. So There's another piece of this which is critical. Now, our original bold move had hyperscalers involved taking an equity position in Intel Foundry. Having circulated our original bold plan and gotten some feedback from folks inside the government and in other parts of our community, but from private equity, from people who kind of know the scene, from some of the hyperscalers. I actually hyperscalers won't like this scenario. I asked Matt Garman, CEO of AWS at reInvent, in a public analyst forum, if he felt that. I asked him the three-part question. Number one, do you feel like we have to have US-based advanced manufacturing of silicon? Yes, he said. Number two, does that entity have to be a US headquartered company? And he said, I'm not so sure. And I said, three, are you willing to help fund that, take an equity position in the new foundry? And he said, I don't really think so. So they don't want to do this. But here's our plan, guys, if you bring up the next slide. Basically, the Foundry of America, instead of the hyperscalers taking an equity position in the new joint venture, the joint venture would be a US domiciled company. And instead of equity, we have a take or pay model, meaning you got to take whatever wafers you get and you got to pay for it. So you're locking in demand from the cloud and internet giants. And we've cited Apple, Amazon, Google, Microsoft, Meta, NVIDIA, and Intel, putting in the following amounts. So we've got 6 billion for Apple, and then 4 billion for the others, 3 billion for Microsoft, Meta, et cetera. Are these the right numbers? I don't know. Maybe Apple should be a little bit more because their wafer volumes are higher. So the upfront commitment is 25 billion. They've got it on their balance sheets. Put it in up front, and then you've got between years 2 and 5, you've got milestone payments and you can see here, 5 billion, 3 billion, 2 billion, et cetera, over the next 5 years, including Intel, putting in wafer volume commitments. Now, these wafer volumes, they're approximate committed wafers. We don't really have great visibility on that. One could say, well, Apple's volumes are maybe quite a bit larger than some of these other ones. It requires more research, but so think of these as hypothetical. But you're talking about better part of a decade contract duration to give Intel the time. Remember what we said up front. Intel either needed unlimited capital or unlimited time. It didn't have either. So you see the bottom line here is you're talking about 25 billion up front plus 19 billion over 5 years for these internet giants. So the whales are going to put in 44 billion. The CHIPS Act, the US government, US taxpayers put in 27 billion. And then you got 25 billion in a combination of debt and maybe a little bit of equity from private equity. And you've got, thank you guys, now you've got nearly $100 billion to get this joint venture off the ground. And critical to this is that TSMC is bringing in the expertise, the know-how, the skills, the R&D, and that IP transfer has to occur to the joint venture. Why would TSMC do it? A couple of reasons. One is it's a hedge against China invading Taiwan or taking over Taiwan. Two is they get a substantial portion of the JV. And they reckon Morris Chang, who started this, who reckoned what a visionary, but TSMC understands the importance of having a more broad-based supply chain and having big ownership in a U.S. domiciled joint venture gives them significant both negotiating leverage and hedge against the impending China threat. Why, you ask, would the hyperscalers do it? Well, not only do they get priority access to US-based manufacturing, and not only is it the right thing to do for America, but the US government should be smart and take its foot off the neck of Amazon and Google and Microsoft and Meta and NVIDIA and basically relax some of the regulations that they're imposing on these companies. I mean, every day we open the paper, there's a new lawsuit against one of these companies. Now, we're not saying they should get a free pass. They shouldn't. They should abide by the laws of monopoly control and the Sherman Act, the Sherman Antitrust Act. No question. But right now, we feel like this is so strategically important that easing up we often say, getting the foot off the neck of these hyperscale giants with regulation and the Lena Khan style of over-regulation, in our opinion, should be the quid pro quo to get them to participate. And frankly, if they don't participate, they should squeeze them a little bit and turn up the volume. I think it's a good quid pro quo for the internet giants, and it's the right thing, and it's the right thing for the long-term viability of their supply chain, which they all rely on. Okay, let's wrap, guys. If you bring up the last chart here, we'll just summarize what we just talked about. Don't make a quick fix Intel board and give up and sell the design business. That is just lame and a cop-out. You have the responsibility because you enabled this flawed strategy. So you got to do better. And it's critical for national security. I haven't mentioned at all the US military. They have a huge stake in this as well. You spin out the foundry, just like AMD did, just like IBM did. And the what's left will flourish. Took a while for IBM, but very clearly AMD, as an example, is highly relevant. There's an irony here in the history of repeating itself with Intel and IBM. I've said a few times on the CUBE pod. IBM was the original monopoly in the tech industry. They handed that off to Intel and Microsoft. Intel, when they chose to outsource the microprocessor to PCs. Well, Intel's monopoly lasted for a couple of decades, and look, they ended up the same place as IBM did, with a foundry that was, a shackle on its wrists. So there's lessons to be learned there. If TSMC puts in IP and skills, that is critical. Without that, there should be no deal. And I'm not sure where that leaves us. So TSMC has some negotiating leverage here, and that's why I think they deserve a higher stake. But a TSMC-led JV in the US with US taxpayer money and hyperscale volume commitments with those other internet giants, that will increase the probability of having advanced manufacturing onshore. Doesn't guarantee it, but it buys you the 10 years or even 12 years necessary to close that gap that exists. Doing this, following this formula, allows Intel to keep its CPU and AI and GPU, even though it's behind business, and aligning with what we all want, which is better supply chain resilience and onshore advanced manufacturing. And look, ultimately, if you spin out the foundry, it's going to liberate the design business, and we think will allow Intel, an American icon, to regain its position in the marketplace. Thank you, guys. Appreciate that. All right, that's it for today. I really want to thank the Palo Alto crew for stepping in, for Ken Schiffman and Alex Meyerson, who also do our podcast. Kristen Martin and Cheryl Knight help get the word out on social media. Rob Hof, thank you for all the great work you do at SiliconANGLE.com. And our partner ETR. There's not a lot of ETR, no ETR content in this one, but check out ETR.ai. They get the best survey data into business. And remember, every week we publish on SiliconANGLE.com and thecuberesearch.com. These episodes are available as podcasts wherever you listen to your podcast. All you got to do is search Breaking Analysis Podcast. And thank you for watching. This is Dave Vellante for theCUBE Research Insights, powered by ETR. And we'll see you next time on Breaking Analysis.